Hello, everybody, and welcome to the Trader Newsroom. We have an exciting show for you today. Non-farm payroll number comes in better than expected. What does that mean for the markets and the economy? Welcome to today's show. My name is Michael DeJoy, and I'm joined by my co-host, Joe Malandrino, global markets reporter from NASDAQ, who has just completed a whirlwind world tour. So where were you, Jill?
Well, we covered since mid-September conferences in New York, Barcelona, Vegas, Singapore, Vegas again, and we're home for the rest of the year. And then we are back in Vegas second week in January to cover CES, which is always super exciting. It's huge. It's massive.
That's awesome. So you've been around the globe and all over the United States. Well, great to have you back for the holiday season and getting ready to go into 2024. So let's jump right in. Today we had some big news related to non-farm payroll numbers. The non-farm number came in at 199,000. That is 9,000 better than expectations. The expectations were for 190,000. Also, unemployment drops to 3.7%. Why did so let's just jump in and digest that number and go into that number. So what are your thoughts on the effects of unemployment and of course the slightly better than expected non-farm number?
Well, it's interesting because when the data first came out, it raised concerns that the economy was running too hot for inflation to cool. And would it be enough for the Fed to put rates on hold? There is pricing in, at least for the second half of 2024, that they will start to cut rates. Some traders even expect as early as March. On the other hand, the monthly jobs report could also support the notion that the Fed is fulfilling its mandate and it's guiding the U.S. economy toward a soft landing. It's a steady economic recovery, even though inflation is still high, but data suggests that it's coming down. So, I also think investors are looking at the University of Michigan survey that showed inflation expectations have dropped and consumer sentiment is moving higher in December to its highest level in July. So I think at first blush, the market interpreted this as, okay, rates are going to be higher for longer because the economic data is just, coming in so well. And that surprise number with the unemployment rate going to 3.7%, and virtually everyone who wants to be employed is employed. The market interpreted it as, okay, higher rates for longer. But then when you kind of take a step back, put this all together, perhaps it suggests that the Fed is doing its job and guiding us into a soft landing, no landing, whatever you want to call it.
Yeah. So that's actually going to be mentioned in one of our upcoming slides. But let's first cover, why did Treasuries spike? And of course, this is the soft landing. Has the risk of recession been averted? So let's first jump into and unpack the Treasuries, because as the non-farm number came out, the Treasury spiked.
Mm-hmm.
What is that?
Well, again,
how do you
I think it's reactionary, just like what we saw on the equity side of the equation, that you're going to get these reactionary moves in different asset classes based on how the market is interpreting it. And I think, and you always see that kind of reaction, Mike, whether it's to macro data, to earnings data, you're going to see a reaction to one way or the other until, you kind of think about the fundamentals and then put things into perspective. It's interesting. I don't think, well, actually, not that I don't think, but I mean, we saw in analyst projections in the beginning of the year that anyone expected the market to do as well as it has done. So to me, that suggests that multiple asset classes are still so predisposed to any sort of headline that's coming out, because it has been such a surprise this year by how well, the market has performed.
Got it. So do you think that the soft landing or the recession risk has been averted? I've heard a lot of that today, certainly in the unpacking of the Michigan sentiment number, which is one of the key inflationary surveys. Do you think we have the Fed has orchestrated a soft landing, or is the jury still out?
If we were to ask this question in the beginning of the year or even 6 months ago, and we have asked this question, and Mike, I would say, one data point is not a trend make. But I think what we're seeing here is a trend firmly intact where employment remains strong. Data suggests that inflation is coming down, or at least not rising. And it might, clearly prices aren't the same as they were prior to COVID. And I don't think we'll ever get back to those levels again. But the data does suggest that it's at least not moving any higher from here. So is it too early to call that they have, orchestrated a soft landing? I still think that the jury is out in terms of how much longer the strength of the consumer will persist. We're coming into, we're clearly in a heightened geopolitical situation. Then we have the elections in the US that are coming up. So there's always going to be outliers out there. The market's always going to climb some wall of worry. But to say, have they completely orchestrated it? I think we'll be able to, well, first of all, we're coming to an FOMC meeting next week, and we'll get more commentary from there. So I think it's going to be a really important meeting, as one would imagine that the Fed is, going to probably have forward-looking statements as it goes into 2024. I don't expect them to have, major change of composure. I think they're going to hedge and keep consistent with their messaging that they're going to remain data dependent. Employment and inflation are going to be what guides them. I think once we start to hear commentary around, we're done raising rates, we're thinking about cutting in the second half of 2024, I think then we'll get more clarity in terms of, can this definitively be said that, we've had a no landing, soft landing type of avoidance of recession. Because again, 2023 was a complete surprise.
Yeah, absolutely. I would say that from what I'm hearing, I would say that the jury is still out, but certainly, the economy is slightly hotter than the Fed probably would like, but overall it has held up very, very well. And that's pretty much, I try to always look at the market and the data objectively. And, if you're looking at the charts, the Dow jumps to a new high for 2023, as the NASDAQ, which has really led this rally, as you join us, usually you join us from the NASDAQ. I mean, really, the NASDAQ has had a tremendous performance in 2023, and especially, the turnaround from the really near or just starting correction levels into basically almost new high territory. There is some profit taking technically going on in the markets, especially on the NASDAQ, as it seems like money is rotating into kind of the old economy stuff, old economy stocks. That is a sign of monetary rotation, which is not uncommon at the end of the year. And that brings me to the next point. Is this potentially window dressing for 2023? Window dressing is where, funds try to make sure that they own the best, hottest stocks that were the best performers for the year, and sometimes even for the month or the quarter. Needless to say, what are your thoughts on this potentially being window dressing?
I'm not sure if I would call it window dressing necessarily. I think people are certainly going to be more strategic in terms of how, they look at tax selling at the end of the year. I think that's probably more of it than anything else. I'm not quite sure it's window dressing, to be honest with you. As you know, we have strategists in and out on the show all the time. And honestly, that is the first time that question has been pitched, at least to me anyway. Have not heard much about that. Honestly, it's been more on, strategy around taxes more than anything else is really what we've been covering.
Got it. And I think you brought up a couple of key points that we all have to take into consideration. Obviously, there's a tense geopolitical situation around the globe, which anything can happen. And 2024, we just had a debate. I was actually watching some of the clips from the debate, and we are going into an election year, which generally is a year of heightened volatility. Markets tend not to like uncertainty, and I think there's an extra batch of uncertainty at this particular election. So those are two very good reasons why the jury for the soft landing might still be out. Last item, We touched upon this a little bit already. Key inflation indicator, this actually came out last week. Key inflationary indicator, personal consumption number rose by 0.2% for the month. That brings us to a 3.5, almost end of the year. This basically is 2023 with the exception of December. So this is not the final number, but this is 11 out of 12 months. So year over year, we're at about half the inflation level that we were last year going into the end of 2022. What are your thoughts about inflation going forward, just to kind of wrap things up before we wrap it up for the weekend?
Yeah, it's kind of like what I alluded to before, that we're not going to see, with the exception of gas, because, of course, that's going to continue to fluctuate. But I think, as it relates more specifically to the consumer, whether you're looking at rents, package prices, whatever the case may be, you have to remember when you're talking about inflation, only going up 0.5%, or it fell 1%, or it's unchanged year over year. That's from 2022 to 2023. And that's why things still feel very expensive, because they're certainly more expensive, 10 to 15% more in many cases from, prior to when the pandemic started. So the baseline is different. So for example, using round numbers here, let's say we used to pay, let's call it $8 for a box of cereal. I'm trying to use round numbers to make it easy, right? If it goes up, to $10 from a percentage perspective, that's a lot. But if it hasn't gone up, if it's still $10 from 2022 to 2023, in theory, it's unchanged. But it feels like it's a lot more because, we were paying $2 cheaper just, 2-3 years ago. So I think consumers just have to deal with, like, this is the reset of, what the consumer environment looks like going forward. And look, Mike, you and I have been talking about this ever since, the Fed made the comment that they see inflation as, a transitory phenomenon. And the first comment that you and I had was like, wages aren't transitory. If you're going to pay $15 an hour, it's not going to be $13 next year, right? So I just think we've adjusted, this is what wages are. We know prices aren't going back to pre-pandemic levels. So I just think it's really a consumer reset here.
Got it. Yeah, no, I agree. I think that this is for the consumer, numbers have, you have to figure that if it's still going up, if something was $100, let's say 2 years ago, and it went up 8%, right, from 2 years ago, now it's $108. Now you take 3.5% on top of the 108. So now it's at $112 or $115. So it's compiling. So the inflation, which has been going up now for, I'm going to say, since 2020, inflation has been a concern since 2020. So we have that compiling inflation now going on for what is almost 3, going on 4 years.
Mm-hmm. Yeah.
All right. Well, listen, that pretty much wraps it up for us. I'm going to jump to the charts. I just want to wish you a wonderful holiday season, and we'll see you just before Christmas, and then we'll see you in 2024. So thank you so much for your analysis, as always, Jill.
All right. Sounds good. Have a good weekend, everyone. Thanks, Mike. See ya.
Thanks, Jill. All right. So just going to jump to the charts here. All right, bringing up my Dash Trader as I go to the charts. Okay. First things first, let's take a look at what the market is actually doing today. So today is 12/8 as we do the newsroom here. We have a significant move up on the NASDAQ. We did gap down, and then we have pretty much rallied the entire way through. So we gapped down. That was the kind of on the initial knee-jerk response of the non-farm payroll number. And then we've obviously been on fire pretty much since then. This is on the QQQ. Let's take a look at the SPY. Similar picture on the SPY and on the DIA. So we have the Dow, really kind of forming a consolidation on low volume, which usually indicates a breakout to the upside. So this would be a continuation move. So this would be a kind of a continuation pattern, and forming a bit of a base here for another breakout to the upside, going to new highs, closing out the year pretty much near the highs. From my early indications, the Christmas shopping season, has been fairly good. So Black Friday, Cyber Monday seems to be, in line with expectations at the very least. Let's take a look at oil. So oil is a double bot, kind of a bottoming pattern. We had a gap up. Obviously, oil goes up when the economy is looking healthy. So if the jobs number is better than expected, then we would expect the oil number or oil prices to go up. That means that people will consume more oil, and therefore prices at the pump will be slightly higher. Oil has pulled back quite a bit, and probably looking like a good place. This is the weekly chart on oil. We kind of just kissed the point of control on the weekly chart on USO, which is a ETF that tracks oil. Now let's take a look at Apple. Apple here is kind of touching all-time highs. We formed what looks like a continuation or bull flag, bull pennant. And now we've kind of made the final run up to the highs. And then we're hitting the resistance level at the highs. And let's see if that is a breakout situation, or because we've run so much, the market is a little bit exhausted at this point. Okay, so here we have Microsoft. Microsoft made a tremendous rally, kind of also a kind of new high situation. Let's go back to our weekly chart. Microsoft put in a new high, but has since then kind of pulled back and kind of settled in here. But it's has a crossed over moving average. Microsoft has been a leader in this entire run up, as has been NVIDIA. Right, NVIDIA made a nice little pullback after hitting all-time high at 500, and also NVIDIA now looks like it's put in potentially a higher low after that consolidation. So we will see how it goes for NVIDIA. So we have NVIDIA, we have Apple, we have Microsoft. Let's take a look at Google. I like to go through all the big tech stocks. Google, big gap up, kind of a consolidation. Possible triple top, not quite as bullish of a chart. Amazon, AMZN, not quite as bullish of a chart. Amazon has a cup with a handle, so I think that the market is expecting some kind of a bullish move from Amazon, especially on the holiday season. So Amazon tends to do very well these days in the holiday season, as most people buy their products online. And judging from the malls, which have been fuller than usual, overall malls have been very empty and getting emptier. And in some rural places, have almost been on the verge of shutdown. They've been becoming pickleball courts. Needless to say, overall markets. Let's take a look at gold, the old man. Gold pulling back from what was an all-time high, or recent high. I believe it kissed the all-time high as well. But certainly gold, pulling back some as the economy has some kind of a little bit more regularity and security to it. So on that note, we're going to wrap things up. We did just end our #1 best trader competition. We have our 3 winners. And let me make sure that we are sharing the right screen. New share. Here we go. Let's wrap things up. Stay up to date with all things DAS by signing up to our monthly newsletter emails. Simply fill out the form at the bottom of our webpage. Subscribe to our YouTube channel, DAS Trader TV, for our newsroom reminders. Follow us on social media for all things DAS at LinkedIn, Twitter, Facebook, and Instagram at DAS Trader etc. I want to very quickly wish everybody a wonderful weekend. Trade well, everybody, and see you next time. We are taking steps to move the newsroom to a weekly show, and we look forward to having you all with us as we go into 2024, as we move towards a weekly newsroom show. Thank you very much. See you in 2 weeks, and then see you in 2024.